NIO is the biggest Chinese electric car company that makes high-tech, premium electric vehicles, known for their advanced battery swapping, autonomous driving, and smart features, aiming to compete globally in the EV market. However, the stock price is down 47% year-to-date and down 92% from its all-time high. NIO is a company that has a market cap of $9.6 billion, and the company has made 8.7 in revenue in the last 12 months. They haven't made any profit yet, which is why net income is negative $2 billion, EPS negative, and there is no PE ratio as well. However, a very positive aspect about the company is revenue growth. As you can see, the revenue has grown from 7 billion yuans 5 years ago to 63.5 currently, which is $8 billion US. Deliveries are growing massively as well, and if we go to the last quarter earning report, they delivered 57,000 vehicles, representing an increase of 143.9% from the second quarter of 2023 and an increase of 90.9% from the first quarter of 2024. The main problem with this company is that they are not making money. As you can see, net income is negative 20 billion yuans, which is negative $2.8 billion. Because they are a car company, their gross margin is very low and is currently at 7%. And obviously, profit margin is negative. Another thing that I don't like about the company is the number of shares outstanding, which has been increasing massively over the past years. This is horrible for investors as you are getting diluted and you own less of the company. Then, in order to calculate the intrinsic value of the company, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a summary analysis with low, middle, and high assumptions. As you can see, the intrinsic value to it is between $1.65 per share and $16.38, and the stock is currently trading at around $4.4 per share. Moreover, this means that if my low assumptions occur, you're going to make a negative 6% annual return on your money, middle positive 18%, and high 35%. However, this spreadsheet assumes profitability from day one, and on my low assumptions, I assumed an average profit margin and free cash flow margin of 1% for the next 7 years, middle 3%, and high 5%. Because the gross margin was around 7%, so it cannot be more than that. And I also assume they don't issue any more shares. But if we assume they continue to do so, let's say they issue 3% of their shares annually, the valuation becomes less attractive. For the rest of my assumptions, I assume 15% annual revenue growth on my low, 20% on the middle, and 25% on my high. And I assumed a 20, 22, and 24 PN price to free cash flow at the end of the 7 years. The spreadsheet does not attribute any value to the balance sheet, and NIO has a great balance sheet, as they have $4.9 billion in cash and $4.5 in debt. In conclusion, NIO is growing revenue and deliveries very quickly, and as you can see, they are still expected to do so. They are reporting earnings this Wednesday and are expecting to make 19 billion yuan in revenue. However, they are expecting to make negative EPS, and if we take a look at what analysts are expecting for the next years, they are still expected to lose money 3 years from now. Therefore, we don't know when they are going to start to make money, and therefore this is a very risky investment, which is why I am personally not interested at the moment. But remember that this is not financial advice and you should always do your own research. I hope you found this video valuable. Let me know what you think about NIO stock in the comments, and I'll see you in the next one.